and Jobs Act of 2017 came out just in time to make a big headache for people that are working remotely. The tax deduction for working at home or travel expenses and those kinds of things are no longer deductible, unless you know a couple rules. Deducting unreimbursed employee business expenses went away with the 2017 Act. However, there are still ways you can take these deductions. A few rules have to be followed. If done correctly, it can be very beneficial to both the employer and to the employee. It's called an accountable plan. It's something that you need your employer to work with you on, and it has to be approved by them. However, the employer can benefit as well, so it's actually a pretty good deal. Special care does need to be taken, however, when you use an accountable plan. You can't just do kind of a switch or a bait and switch type thing. So let's talk about some of the details with an accountable plan and see if we can get those deductions back from the Tax Cuts and Jobs Act of 2017. The second way is to have a stipend where you then turn in receipts and then your employer would reimburse you for any excess, and if the employer gave you too much of a stipend compared to your receipts, you would return that money within a certain time frame. We'll cover some of those details right now. One caution before we go forward is not to use this as wages or salary replacement. You cannot actually take some of the salary or some of the wages and then reclassify it as a reimbursement, thereby cutting the taxes. It actually has to be a reimbursement of that expense. On the other hand, there is nothing wrong with saying to an employee as an employer, or the employee saying to the employer. However, there is nothing wrong with having a different wage based upon if you have expenses reimbursed or not. So for example, somebody might say if they're in sales or if they're working from a home office, they might say, well, I'll get $100,000 per year as a wage. However, I'll take a $90,000 per year wage if I have my expenses reimbursed. That is an acceptable plan. You just can't go out there and say, I'm going to get $100,000 per year, and then when you turn in your receipts, they adjust your wages or your salary down by the exact same amount, and then you don't have as much wage. That would be unacceptable. And in 2012, the IRS had a revenue ruling that detailed this exactly, so that you cannot actually turn wages or salary into the reimbursement plan or the accountable plan. Always have the accountable plan separately. If you do that, this is going to work golden. Now let's talk about some of the rules involved in an accountable plan. For the employer to cover these expenses, they have to have a business connection. So the reimbursement has to be for a job-related expense, and the employee had to have incurred it, and then the employer would reimburse for that. Substantiation means that a receipt needs to be provided or some kind of additional form of substantiation. And any excess, if there is a per diem or some kind of stipend that's being paid, that the excess amount would be returned to the employer within a certain time frame. How that works like this: the employer would receive an advance within 30 days. So for example, you could have for the month of May, at the beginning of May, your employer can say you have a stipend for this month of $500, and then if you do not produce enough receipts, you would have to pay some of that back. The employer can pay you the excess when you turn in those receipts. The employee also has to adequately account for the expenses within 60 days. So once the stipend is received in these situations, you have 60 days to turn in your receipts, and then you have 120 days, however, to reimburse that amount. So the reason for these different days and these different time frames going on is, let's say in May you have a $500 stipend, you have $300 in expenses, you have more time to pay it back. You might have additional deductions in future months that would offset that, and that would keep the accountable plan current without any problem. The employer should provide a statement to the employee at least quarterly, but no less than every 120 days, outlining the fact that they were given a stipend and then how much was reimbursed. If it's an accountable plan where you're just being reimbursed and nothing else, there is no problem. However, if you're given a stipend and have an accounting to provide to the employer, and the employer hence to you, then every 120 days there would be a requirement. Quarterly would be nice. So once every quarter you receive the stipend, let's say at $500 per month, so you see the $500 each month, and then you'd see the receipts that were turned in. So May, let's say for example, you had $150 in expenses, you had a $500 stipend, then there's $350 that you would have to return back. There's the days that we had talked about, and then you could then in June maybe have $2,000 in expenses, and now the employer would owe you some money. To recap, the accountable plan allows you a way to get around the rules that say you can no longer take unreimbursed employee business expenses. Those deductions went away in Schedule A where they were limited in the first place. But the employer wants to do this as well, because the employer gets a full deduction for those expenses. You do not have to pay for any of those expenses yourself. They get reimbursed. If there's a stipend, it's also being accounted for appropriately. Couple things to keep in mind before we close. There's more than one way to account for some of these expenses. So for example, you can use actual expenses. So you have a home office and you might say, I have 10% of my home for my home office, and 10% of your utilities would then be considered an expense, which could be reimbursed. 10% of property taxes, 10% of mortgage interest, those sorts of things. There's also a safe harbor of $5 per square foot up to 300 square feet or $1,500 per year. So your employer could in effect pay you $1,500 for a home office per year as a safe harbor. Same thing applies with the mileage for travel expenses. So you can use an actual expense for your car and have a prorated portion between personal and business. You could also use the mileage rate, which would be much more simple. Same thing applies for travel. Your employer also has the ability to pay you a per diem for travel expenses for things such as meals and entertainment. So if you have meal expenses on the road, your employer doesn't necessarily need the receipt. They just need to know that you were on the road for business purposes for that particular day, and then you get a certain amount being returned to you as a reimbursement. There's no additional accounting allowed. If you're an independent contractor, you're not allowed to take a per diem for actual hotel, but if you are actually an employee of a company, not your own company, then you can actually use a per diem. Your employer can say, I'm going to give you so much for a hotel, and that's all I'm going to give you as a per diem, and then whatever that actual expense was would not really make a difference. The per diem would be used instead.